Hello everyone. Today, Trafigura reported its results for the 6 months to the end of March. I'm delighted to be joined by Stephan Jansma, Trafigura's Chief Financial Officer, to discuss the results and what's behind them. Stephan, welcome. Can we start at a high level? How would you characterise this set of results?
I would characterise the first half of 26 as a strong, resilient performance across all pillars, resulting in a profit in excess of $4 billion.
Okay, and as you were saying there, the drivers are pretty much spread across the business.
Indeed, across all divisions, strong performance across, not because commodity prices are higher, but really because of a strong demand for our supply chain services by our customers.
Yeah, and I think it's important to note probably that the period does span up until the end of March. So this is not just covering the crisis in the Gulf that we've seen.
Correct. Our Q1, October, November, December, was our second best Q1 ever, which means that a lot of the profit that we're now reporting was already generated in that first quarter, and Q2 was a continuation of that strong profitability that we had in Q1.
Well, let's move on to the Middle East. Obviously we have seen extraordinary sort of volatility in prices, lots of news, lots of headlines, moving markets. How has the company been able to manage risk in that sort of environment?
Sure, I'll highlight 2 points. Right, on one side, we are a very significant trading company, but we're maybe not the largest in the Middle East. So from an operational perspective, in terms of assets and ships, we were not very impacted. From a liquidity perspective, we've learned a lot since 2022. So we put in place over the last 4 years a lot of measurements which reduced our liquidity risk. So for example, on the LNG side, we do a lot of exchange for physical, which managed to reduce the liquidity risk on initial and variation margin. And we have become a self-clearer on ice. So a lot of the oil business is self-cleared on ice, which means you don't have initial variation margin, but you have stress loss, which our margin management team optimizes between those two.
But one of the other measures in there was obviously putting in the contingent liquidity facility, the $3 billion. What was the thinking behind that?
So we reached out to the banks, and within 7 business days, we reached $3 billion of facility. It's a liquidity backup facility based on $8 billion of commitments. And we did it for 2 reasons, right? So one reason was we wanted to show the market that Trafigura always has access to liquidity. We are open for business. Secondly, we also wanted to give the same signal internally to our traders. We're built to trade. We want to show our traders as well that go ahead, fulfill the requirements that you see with your customers, even if it requires some more liquidity, because we have that liquidity. And we're very pleased to see that confirmation from our banks that they have the confidence in us, that they understand why we need the liquidity, and they have the confidence in the balance sheet and in the management and in our strategy to give that support.
And you said in your statement that the liquidity position is now the strongest in the company's history. Do you envisage keeping at these sort of levels or it coming back?
Indeed, it's true that we're at record level. So we have $8 billion of readily available cash and $12 billion of committed clean funding available. So in total $20 billion, which is by far the highest ever. And I think in this environment, it is wise to keep some more liquidity. When markets normalize, I could imagine that we would go down to more normalized levels that you've seen in the past.
So just to move on to another bit of the results, the balance sheet, it's grown significantly during the period. I think total assets are up 41%. How should we be thinking about that?
It's a function of our working capital, which is dominated by 3 elements. One, it's our volume. If I look at our energy volume, it is up 21% in the period. Secondly, it's due to the prices. Right, the gas oil price is up 97%, crude is up 77%, silver is up 67%, right? Yeah. So higher prices, of course, have an influence. But thirdly as well is that we have held a bit of slower asset conversion. Due to the supply chain disruption, sometimes we had to sail a bit further towards our customers and do a bit of rerouting. Again, a bit slower asset conversion means more working capital requirement. So our balance sheet total increased, yes, but 95% of that is purely working capital and a little bit of growth in fixed assets, which is our continuous investments into our vessel fleet.
And just talking on assets there, there are 700 million, I think, of impairment charges in the period. What does that reflect?
Yeah, it's really the asset division in motion now. Okay. I think last year we announced the asset division and it was put in place and they took control of the asset. This year you see them really optimizing the flow of assets that we have in the books and being able to look at assets and say, well, this asset maybe belongs better to somebody else who can generate more value out of it. So selling some of the assets, such as Neostar in the US, but at the same time also recognizing that some assets we could expand in. So for example, our marine in France, we expanded our downstream distribution there through Greenergy to increase our market share on that market. I mean, we're overall happy with the roughly 10 billion of fixed assets that we have as a company, but we continue to look to optimize that $10 billion of fixed assets.
Now, I realise this is a difficult question, Stephan, because the outlook is extremely uncertain. But how do you see the second half of the financial year evolving?
Sure, it's a very difficult question. I have to say the first week started positively, but there's still more than 4 months to trade, right? So in that sense, it's very difficult to make a projection. I would say that in a volatile market, our customers need us more than ever. We're a shock absorber in the industry, so the more shocks there are, the more relevant we are for our customers. So together with our well-prepared balance sheet, our high liquidity, we're well positioned to support our customers during these times.
Okay, Stephan, thank you very much.
Thank you, Neil.